Welcome to the Transparent FX Academy. I'm Nick and I'm a top author and trading view with over 190k reputation points. In today's video, I will be sharing the only day trading strategy that you will ever need because it's based on very simple principles that you can then take and adjust to your own trading needs and trading personalities. So it will be a very complete video, very interesting. I really suggest that you check it out to the end. First, I will be explaining the technical rules. Then we will go and see what we have from a risk management perspective for the strategy. And as you know, risk management is a key element for any trading strategy. And then I will also be elaborating a bit on how to adjust the strategy to your needs with proper backtesting and fine tuning. So all these lessons are also very useful for any kind of trading strategy, not really only this one. So I really suggest that you stick to the end of the video to have a comprehensive view of everything that I want to share here. Let's get straight into it. Okay, so let's start from the first block, which is obviously the technical rules of the strategy. Now, before we put together all the rules, I first want to clarify the concepts so that we are all on the same page. In fact, I want to quickly define support and resistance in the proper way, how to drop on the chart the 50 EMA, and how we will be looking for stop loss placements and take profit placements according to the rules of this strategy. First of all, support and resistance. Now, when it comes to identifying support and resistance levels for this strategy, but actually in general in the market, what we have to look for are the swings that the market creates. In fact, if you are in an uptrend, you will see a series of higher highs and higher lows. Every time that the market goes and creates a new higher high, the previous high is a level of previous resistance, which the market is supposed to go and retest as new support because previous resistance, once it gets broken to the upside, is turned support. And then you expect the market to reject to the upside, continuing the uptrend. Same thing if you have a bearish trend in which you have a series of lower lows and lower highs. In a situation like this, you have a series of support levels, like this one here, which are the previous lows before the correction starts, that when the market breaks them to the downside, these previous levels of support become resistance and you expect the market to go and test them and then to reject them to the downside. For example, to identify one of these levels, if we look at this chart, we can easily find it here, but actually we find them everywhere. This is just the cleanest one. We can see how from here the market was finding support during this downtrend. The market here printed these two lows. The market then broke these lows to the downside. At that point, this previous support was broken to the downside with this impulse and became resistance, after which you expect the market to go for a retest of previous support and resistance and then to reject the level to the downside, which is in fact exactly what the market did here. So support and resistance is defined as the last time that the market went to the opposite side. So if now here the market is moving to the downside, whereas the last time that the market went to the upside, the last time that the market went to the upside was with this move. So this is the previous support, which is now turned resistance. Okay, this is how we will be identifying previous support turned resistance and previous resistance turned support. Exact same concept, simply to the opposite side. Another very important concept for the strategy is the 50 EMA. Now, that is basically the exponential moving average taken on a 50 period. Now, in order to place that on a chart, you simply have to go here to indicators, then you will be basically putting exponential moving average, and you will simply find it here on the chart. Then you have to go to settings, and you have to change the length from 9 to 50. And then you can obviously also change the color as you prefer. In our case, doesn't really make any difference. So now you also have the 50 EMA on the chart. Now, why are we using the 50 EMA? Because very often the 50 EMA will be acting as strong support and resistance. okay, on all time frames, but especially on the 1 hour time frame, which is a very convenient time frame, especially if you're looking to day trade. Now, what we can see, in fact, is that the market tends to respect this 50 EMA as resistance when it is in a downtrend and as support when it is in an uptrend, okay? Now, the next concept will be stop loss placement and take profit placement. Now, when it comes to placing a stop loss, if we're looking for a short, we will be placing our stop loss above the previous high. So if you have an impulse to the downside followed by the correction, the stop loss will be above the previous high. Same thing if we're looking for a long position. So for example, if we have an impulse and correction, the stop loss will be below the previous low, okay? Now, don't worry if you're starting to get confused, because when we will put everything together in just a few moments, everything will look extremely simple. When it comes to the take profit placement, I will show you that right now when we go into actually putting everything together, because the take profit placement is based on the risk to reward, which is something that anyway I will elaborate on when we move to risk management, okay? But let's move to the actual rules of the strategies to start to put everything together and simplify things, okay? The first thing that you need to identify for the rules of the strategy is the trend, okay? Do you have an impulse to the downside or do you have an impulse to the upside? For example, taking back the example that we were using before, here you clearly have a strong impulse to the downside. When you have an impulse to the downside, we have to identify, according to the rules, the support and resistance. Now, in this case, the previous support and resistance, as we have already identified, would be this one here. Previous support here, again here, which is now turned resistance here. The second thing that you have to look at is the 50 EMA. Is the 50 EMA lining up with this previous support turned resistance? So using the replay tool here, we can easily see how the market was looking at when we were at this level. We can see that we have previous support and resistance here, and the 50 EMA basically lining up very closely to this zone, meaning that we have a confluence of resistance at this area. Why do we have a confluence of resistance? Because we have several structure resistance zones which are lining up in the same area of price, which in this case, it would be this one here. Now, at this point, according to the rules of this strategy, you would be looking to have a sell limit at this 50 EMA. Regarding the stop loss, as we said before, for the stop loss placement, the stop loss would be placed above the previous high. In this case, this impulse here is from this high to this low, meaning that the previous high is this one here. So our stop loss would need to be placed above this previous high. When it comes to the take profit, we would be aiming for a 1 to 2 risk to reward, okay? The risk to reward ratio needs to be 1 to 2. Now, I will elaborate on why we need at least a 1 to 2 later on when we speak about risk management, okay? Now, since you have confluence of resistance here, what you expect is for this level to hold the market and make a rejection to the downside. In fact, what we can see here is that the market tested the area, triggering the sell limit, and then rejected its zone to the downside, going all the way down for a very nice 1 to 2 risk to reward. Now, let's keep going. Let me show you another one of these setups, but let me show you a bullish one because obviously we just checked a bearish one. Now, in the case of a bullish setup, you would be obviously waiting for a bullish impulse in order to establish a bullish trend, okay, an uptrend. What we can see here is that the market just printed this very strong impulse. So let's say you are getting ready to trade, for example, the London session because the market is just opening. You're looking to trade the London session starting from the Asian session. You just had the shift, so liquidity is starting to pump in the market. You get a very strong impulse to the upside, breaking above your 50 EMA. In that case, what you would be looking for is the support level, right? Because according to the rules, the next thing you're supposed to be looking at is the nearest support. Now, in this case, the nearest support would be the last time that the market went to the opposite side. The last time that the market went to the opposite side is exactly from here. This is the previous resistance, which is now turned support. The next thing would be the 50 EMA. Is the 50 EMA lining up with this previous resistance turn support? Or in other words, is this 50 EMA creating a confluence of support that we expect this market to test and then potentially to reject to the upside? The answer is yes, because in fact the 50 EMA is exactly inside of this support. So in this case, what we would have is our buy limit at the 50 EMA. Regarding the stop loss placement, we would have the stop loss placement below the low, right? And regarding the take profit, we would be aiming for a 1 to 2 risk to reward, which would be here, okay? Now, in this case, the market in fact went and tested the 50 EMA, also lining up with the previous resistance turn support. We had a lot of choppy price action. The market at one point even melted to the downside, creating a drawdown basically. However, we then had the break back above and the market exploded to the upside, rejecting the 50 EMA, rejecting previous resistance turn support, and completing the pattern for a very nice 1 to 2 risk to reward. But at this point, you're still sitting up in front of your computer looking to trade. You notice that the market has in fact created another impulse to the upside, okay? Now, once again, what do you have to do? You have to identify the previous resistance turn support. In this case, the previous resistance turn support would be the last time that the market went to the opposite side. The last time that the market went to the opposite side is from here, right? So this would be the previous resistance turn support. However, the 50 EMA is still way below it, so they're still not really lining up. However, you start to notice that now the previous resistance turn support after a few hours is lining up with the 50 EMA. So at this point, once again, you want to be looking for a buy limit on the retest of the 50 EMA, right? The low is here, therefore your stop loss is supposed to be below the low. And regarding your take profit, as we said earlier, we would be looking for a 1 to 2 risk to reward. Let's see if once again the market triggers our entry. Now, what we can see here is that the market triggers the entry but melts to the downside quite aggressively. The market then starts a move back up, and we have a lot of sideways price action, but basically to this moment, we still haven't hit take profit. Okay, we still have the possibility for the market to create more continuation. That is something that we will see. This is currently live market as I'm currently recording this video. Okay, now it's a very important thing to point out that you need to be looking for clean impulses in the market. Okay, what do I mean clean impulses? You need to be able to clearly identify where is the last time the market went to the upside. This move to the downside needs to be very strong, and you're looking for the retest, okay? Same thing here. You want to be looking for a very clean impulse to the upside. You clearly have previous resistance turn support, and there is where you want to be looking for the retest. Same thing here. You have a very clean impulse, and it's easy to identify previous resistance turn support. However, if, for example, I look here, okay, if I look at this price action here, in this specific area, for me, and for any trader, it's impossible to really say that this is a clean impulse to the downside and this is a correction. In fact, you actually had several movements in the way down. This is actually more of a W formation, which is a completely separate pattern, not really related to this video. So it's very important that you learn to focus on identifying proper impulses and corrections in which you have a very clean move to the downside and very clear correction. In this case, you couldn't be looking for the setup because this is a new level of previous resistance turn support from which you could expect a rejection to the upside. So you need to be looking for a clear downtrend in which you have an impulse, you have the previous support and resistance. You don't want to be looking to trade something like this, like in this case, okay? That is also a very important thing to point out. Now, moving to risk management, okay? So when it comes to the risk per trade, that is very subjective, depends from your own trading personality, how much you want to risk per trade. Usually it is 1%, 2%, 3% per trade. That is more or less what people tend to risk. Some people also tend to risk up to 5% per trade. But what I really want to speak about is the risk to reward. Why are we going for a minimum of 1 to 2 risk to reward according to the rules? The reason for which we're going for a 1 to 2 risk to reward is because this gives you the possibility to be right only 40% of the time and still be in profit. In fact, if you take 10 trades, okay, let's say you're taking 10 trades, you win only 4 of those 10 trades and you lose 6. Now the 6 trades that you lose, let's say for example you're risking 1% per trade. So after 6 losses, you would be sitting with minus 6%, okay? A drawdown of minus 6% because you lost 6 trades. However, if you win only 4 of the trades out of the 10, since you have a 1 to 2 risk to reward, so for every loser you're losing 1%, but for every winner you're winning 2%, those 4 winners actually are giving you a plus 8%. So with having only a 40% win rate, so you're losing more trades than the ones that you're winning, you're still coming out on top. That is why it's very important to always have an asymmetric risk to reward in your favor. 1 to 2 minimum, okay? If you have an even higher risk to reward, is always better. The last thing that I want to speak about is how to adjust the strategy to your needs through backtesting and fine-tuning. Now, these are just basic concepts of the strategy that you can then elaborate on and build upon. You can add Fibonacci's, you can add new EMAs, you can add new rules. The important thing is that you always backtest and fine-tune the strategy. You can't just arbitrarily add rules to a strategy. You have to use the replay tool, or you can just scroll the chart to the right, and you need to properly check which are the patterns that the market is creating over and over again. For example, you start noticing that the market, instead of hitting the previous support and resistance, every time, or at least many times, it tends to go all the way up at the previous high and then starts to move to the downside. In that case, what you would do is change the rules to be an entry at the previous high, right? Therefore, increasing your risk to reward, for example, to 1 to 3. This is just a random example that I'm making of how you can, by noticing the patterns of the market, improve the results of the strategy, okay? So that is only possible, though, if you perform proper backtesting. So over and over again, going over the market to adjust the strategies to your needs. What you can do also is to create a trading journal. If you are in the mentorship program, you have, for example, the trading station, which gives you the possibility to backtest everything and to keep a journal. If not, that you can just use simple spreadsheets in which you record all the charts that you have. So in this case, since we are in the 1 hour time frame, you would have the 1 hour time frame before the trade, 1 hour time frame after the trade. Then you will have some notes and the results of that trade. And then you would just build up a spreadsheet so that you can go back and see, by looking at the spreadsheet, where you could have improved your performance with this strategy. And then you start tweaking the strategy to fit your own trading style, trading personality. For example, you don't like to trade in the morning because you don't have the time, so you only are looking to trade in the afternoon, and in the afternoon you have a different market dynamic, therefore you want to adjust the strategy for that market dynamic. So I could keep going on forever. The bottom line is you need to properly backtest any strategy and adjust it to your own trading style and trading personalities. But I hope this strategy helped you get some clarity on what you're looking at as the basics of, for example, a day trading strategy, and how simple concepts can be put together to develop a decent day trading strategy in this case. Now, if you enjoyed this video, make sure you smash that like button and comment below. It really does support the creation of more free education analysis for all of you, because obviously it helps with the YouTube algorithm, and I will see you in my next video.